the median price of an American home just hit an all-time record high. $429,300. That is the highest price ever recorded for an existing home in U.S. history, according to the National Association of Realtors' May 2026 data. Now here's the part that makes this different from every other housing boom America has ever seen. The people who would normally buy these homes can't. And the data tells a story that should alarm every American who doesn't already own a home. By the end of this video, you'll understand exactly what's happening, why the market got here, and what millions of Americans are going to do when they realize the window to buy may be closing permanently. Let's start with the numbers. In May 2026, the median existing home sold for $429,300. That's up 1.3% from a year ago, modest growth on paper, but it set an all-time record for the month of May. At the same time, the S&P Case-Shiller Home Price Index, a broader measure, showed national home prices grew just 0.7% over the past year. That's the weakest price growth since 2011. The market is slowing, but prices aren't falling. That combination is the worst possible scenario for buyers. Prices still at record highs, but no crash in sight to reset affordability. Now layer in the mortgage rate. As of this week, the average 30-year fixed mortgage rate sits at approximately 6.47%, according to Freddie Mac. On a $429,000 home with a 20% down payment, that's a monthly mortgage payment of roughly $2,290 per month. Add property taxes, insurance, and maintenance, and you're looking at $3,000 to $3,500 per month just to own a median-priced American home. The median household income in America is approximately $80,000 per year. That's $6,667 per month before taxes. Housing experts consider anything above 30% of gross income to be cost-burdened. At current prices and rates, buying the median American home requires spending 45 to 52% of gross household income on housing alone. That is the worst affordability ratio since the early 1980s. So what are people doing? They're renting and staying rented. Redfin calls what's happening right now the Great Housing Reset. Millions of existing homeowners who locked in 2.5 to 3% mortgages in 2020 and 2021 refuse to sell, because doing so means giving up those rates forever and buying a new home at 6.5%. This lock-in effect has choked housing supply. As of February 2026, housing supply stood at just 3.8 months, compared to the 6 months that represents a balanced market. Low supply plus consistent demand equals prices that won't fall. It's a trap, and millions of Americans are stuck in it. Wall Street's outlook for the rest of 2026 is not encouraging for buyers. JPMorgan's housing research desk projects rates will remain locked in the low to mid-6% range through the rest of 2026 and well into 2027. Fannie agrees. The Mortgage Bankers Association projects no significant rate relief before mid-2027 at the earliest. And here's the scenario that keeps housing analysts up at night. If the Fed raises rates in September, which 9 FOMC members are now projecting, mortgage rates could jump from 6.5% to 7% or higher by year-end. On a $400,000 loan, the difference between 6.5 and 7% is roughly $130 per month, or $1,560 per year, or $46,800 over the life of the loan. Here's what the next 12 months look like in 2 scenarios. Scenario 1. Inflation cools, the Fed holds rates, mortgage rates drift towards 6% by late 2027, Affordability improves slightly. Some buyers re-enter. Prices hold or rise modestly. Scenario 2. Inflation stays elevated. Warsh hikes rates in September. Mortgage rates climb above 7%. Demand drops. Listings increase. Prices in overheated markets, Phoenix, Austin, Miami, see 5 to 10% corrections. The irony. The only thing that makes homes more affordable is a recession, which destroys jobs, which makes buying a home risky anyway. For millions of Americans, the housing market has become a no-win situation. So what should you actually do right now? If you're already a homeowner, do not move unless you absolutely have to. Your locked-in rate is a financial asset. Hold it. If you're looking to buy, do the math at 7%, not 6.5. If you can afford the payment assuming rates go up, buy. If you're stretching to make it work at current rates, wait. If you're renting and saving, keep building your down payment. A larger down payment reduces your rate sensitivity and your monthly payment. And if a correction comes, even a modest 5 to 8% dip in overheated markets, you want to be ready. The American housing market is at a record high in price and a multi-decade low in affordability. That's not a contradiction. That's the math of a market with no exit. Watch this space closely. We break down the housing market, interest rates, and every economic shift that affects what you pay every month, every single day. Subscribe and stay ahead of it. See you tomorrow.